Hello and welcome to Market Domination. I'm Julie Hyman, that's Josh Lipton, live from our New York City headquarters. We are giving you the ultimate investing playbook. We'll help you tune out the noise and make the right moves for your money.
From today's top investing stories to Yahoo Finance's trending tickers to the macroeconomic forces shaping markets, we dig deeper into everything you need to know for that last hour of trading.
And here's your headline blitz, getting you up to speed 1 hour before the closing bell rings on Wall Street.
The market, as you mentioned, has capitulated from at least a March rate hike out to June. But I think even that is overly optimistic, again, given the latest inflation data, suggesting that we may continue to see the Fed on the sideline for much, much longer than expected.
We still believe 25% chance this ultimately gets banned for sale in terms of on Biden's desk. But until that, it's not just minutia. Others are going to line up to potentially buy what's really unique golden asset.
It's really not that surprising that Kevin Plank is back as CEO because he had never really gone anywhere. As the executive chairman and chief of brand, he had always been very heavily involved in Under Armour, even when he was not the CEO.
We've got 1 hour to go until the market close. Let's show you where we are trading and how we got here. Look at the major indexes is where we begin. We've got the Dow trading off by about 222 points. That's a drop of about 0.5%. A lot of the sentiment today having to do with yet another hot inflation reading this morning. This time it was wholesale inflation, the producer price index, as well as retail sales rising less than estimated. So we've got the S&P off about 0.5% as well. The Nasdaq down a little bit less. I also want to point out the S&P equal weight index, which we've been watching closely for signs that the rally is broadening, shows today that the declines are pretty broad. And the sort of tail that's wagging the equity dog, I should say, this morning or this afternoon, is what's going on in the bond market. 4.29% is where we find the 10-year yield, up 10 basis points on the day. That's a big upward move here. And if you look at the 5-day, you see that increase that we've had over that period of time. In other words, the outlook that interest rates are going to stay higher for longer is sort of being reflected here. How is that playing out then if we go back to how stocks are trading? And if we go here to what's going on the sector end for the major averages in today's session, you'll see that it is interest rate sensitive groups that are leading the decline. You've got real estate, you've got utilities, you've got financials that are trading lower today. Now let's get it back to Josh for a stock name that we're watching.
Well, Julie, that stock has to be Dick's Sporting Goods. Just look at the move this stock is making in today's trade. It is surging, reporting and delivering despite a difficult backdrop. Comparable store sales, they climbed 2.8%. That easily beat what the street was looking for. As for the outlook for the fiscal year, that was actually in line with consensus, but I know some analysts covering the name Julie saying they think that guidance actually looks conservative in their opinion, just given the results the company posted. Now going forward, the company's also talking about ramping capital investments too, both in e-commerce and brick and mortar stores. Investors clearly like what they see.
Yeah, they do. And this seemed like a surprise, right? Because we've had some weights in other areas that might have been read as sort of negative indicators for Dick's. Other spaces within retail. Obviously, there's also the drama going on at Under Armour today that we're going to dig into a little bit later on here. But so there's relief as well as just sort of pure positive reaction here. One analyst I was looking at from Truist talking about that the company's omni-channel offerings are helpful here. In other words, in plain English, that they sell a lot of stuff online and not just in their stores, that it's both here. And D.A. Davidson pointing out, Michael Baker over there, a friend of the show, said that Dick's is one of just 2 big box names that he covers that are guiding above consensus.
Yeah,
so it just shows you that we're just not hearing that a lot right now.
Stock up nearly 50% already this year. What a move.
Wow, that is a big up move. All right, let's broaden it out here as we look at stocks posting those modest declines as markets react to fresh evidence of sticky inflation. The latest PPI reading coming in above economists' expectations and seems to be another sign the Fed is likely to keep rates higher for longer. Joining us now, Lori Calvasina, RBC Capital Markets Head of U.S. Equity Strategy. Lori, first of all, it's great to see you as always. Thanks so much for being with us. Not great news necessarily for investors today. And what's interesting is you got CPI and markets sort of seem to shrug it off. Now you have PPI and retail sales. You know, Jay Powell was looking for more good data. Are we getting now more meh data that's sort of adding up?
Yeah, look, first of all, thanks for having me. It's always great to see you as well, and be on the show. But look, I do think that this is kind of mad data. In fact, our rate strategy team did reduce the number of cuts they're anticipating from the Fed from 5 down to 3. And so they've, sort of trimmed their outlook a bit. They've always been in the June start camp, and they haven't deviated from that. I do think other investors across the street have had to do a lot more ratcheting down of their expectations. There was this big camp for March, and we've really seen that the March cut camp, has gone through some things, over the last, month or so. It hasn't been so pleasant to talk to those folks. But I do think, as I talk to some of those people, and we've sort of debated what the Fed's going to do with people over the last 4 to 6 weeks, I frankly have heard some concerns about inflation potentially coming in hotter than anticipated. So I look at the fairly muted reaction in the market that we've had to both CPI and PPI, and it actually kind of makes sense to me, because I do think there had already been a lot of worry among the equity crowd that maybe the inflation data was going to be a little bit bumpy on the way down.
Do you think, Lori, just to plan on a point, that maybe part of what's going on is kind of a narrative shift, in that there was this storyline, Lori, out there for a while, well, the Fed's going to have to cut if the market's going to move higher. Do you think maybe now that's sort of changing and the focus is more, well, the economy is solid and earnings revisions moving in the right direction?
We are seeing a little bit of, kind of stabilization earnings estimates the last few weeks, but we did see a little bit of a ratcheting down to start the year. That is not uncommon at all. But I think what I've also noticed in client conversations is people who have been worried about whether or not the Fed is going to cut have generally phrased it as this: oh my gosh, the U.S. economy is so strong, the Fed can't possibly cut. That's sort of the extreme version of that. If you go back to last August, the concerns about the Fed were expressed a very different way. It was, the Fed's just going to keep cutting or keep hiking or not going to cut, and we're going to get a recession. And so the economic narrative is just completely flipped. And if you look at just GDP forecasts themselves, they're around 1.6% in the middle of February, right actually before I went on vacation for spring break. And when I got back from spring break, they had sprung all the way up to 2%, and now they're at 2.1% right now. So we're seeing those economic forecasts move up very, very quickly. And I think even though there's all this Fed angst out there, people have really also been focused on the idea that this economy is not on the brink of recession the way a lot of people thought it was.
And do you think that there's anything in the economic data that we've gotten this week that is going to shake that newfound optimism?
So look, I think there's always going to be a bit of angst, but frankly, Julie, we just got through this reporting season where I do think companies were generally trying to talk down expectations, but that was more on the cost side. If you think about sort of the demand environment, I don't think we really heard anything new that we haven't been hearing for the last 6-9 months, which is that high-end consumers are generally pretty strong, lower-end consumers are starting to show some cracks, but things are generally holding up pretty well. And I think, we just heard 500 companies from the S&P 500, and most of those told us that we're not on the brink of recession. So yes, people are going to pay attention to economic data. And, there may be some hiccups here and there, but I think the preponderance of the evidence is still in favor that the Fed is going to thread the needle and pull this off.
And Lori, the strategist David Rosenberg, he was out with a note to his clients today, Lori, and he said there's two primary concerns for the market right now. One, he said, lofty valuations, his words, Lori, and then he also talked about what he called excessive bullish sentiment. You agree? You think those are two big concerns?
I agree with him on the bullish sentiment. So we watch sentiment pretty closely. And, that's one of the things that's been weighing on us a bit, in the short term, I would say. If you look at AAII net bulls, you've been above the 1 standard deviation mark in terms of net bullishness, not quite back to 2 standard deviations. When you're 2 standard deviations on the bull side, it tends to be a down market over the next 12 months. When you're above 1, but not yet back to 2, it tends to be a flat market over the next 3 months and moderate gains over the next 12. So we're in that latter camp. If you look at CFTC data on buy side positioning, net equity future positioning among the whole buy side and looking across things like Nasdaq, S&P, Dow, mid cap and small cap contracts, just the whole enchilada baked together. What you're seeing is that the positioning has been above the highs that we saw in early 2018 and early 2020 pre-COVID. We've also been well above the highs that we're seeing in 2021 and early 2022. So we do have a sentiment problem out there. I think it's begrudging bullishness. I don't think people, necessarily feel as great, as they have at some of those other peaks on the CFTC data, but it is certainly concerning on the data side. Valuation, I'll take the other side of the argument. What we see on our modeling, and we do our valuation work very, very differently from most people on the street, is that valuations are pretty fair in the context of interest rates, in the context of inflation moderating, and in the context of recovering GDP. Long story short, our model goes back to 1962. We use regression analysis for things like 10-year yields, Fed funds, GDP, and PCE for inflation. And if you look at where the consensus expectations are for those variables at the end of the year, plug them into our model, it's telling us to look for a 23.5 time or 23.3 times multiple rather at the end of the year. And that model was calling for 21 to 22 times at the end of last year and ended up being right. So I think people who, and I don't know, exactly what David's doing on his valuation work, but I know there is a tendency on the street to just sort of look at averages and say, hey, we're this far above average or this far below average, and therefore we're expensive or therefore we're cheap. And we just take an entirely a different approach to valuation, which is saying that things are pretty fair and there could actually be some upside in this market. Our model is saying 5,400 on the bull side.
All right, we'll see if we'll get that bull case scenario. Lori, great to catch up with you as always. Hope to see you again soon.
All right, have a great day.
You too. We're just getting started here on Yahoo Finance Live. Coming up, Under Armour stock is tanking after the news that Kevin Plank is returning as CEO. It caused some analysts to downgrade the shares. We're going to speak to one of them about that move on the other side. Plus, retail sales rebounding, but still coming in short of estimates for February. We'll be joined by an economist later in the hour to talk the current state of the consumer. And after the closing bell today, we're getting the latest earnings from Adobe, Ulta Beauty, and Blink Charging. We'll chat those numbers and much more when Market Domination returns. Time now for call of the day. Under Armour shares are sliding after the company's founder and former CEO, Kevin Plank, said he's returning to the C-suite. Stephanie Linnartz is stepping down after less than a year in the role. The change has our next guest downgrading the stock to hold from buy. Let's bring in Sam Poser, Williams Trading Senior Equity Analyst. Hey, Sam, it's great to see you. So this was a surprise, I think we can all safely say, to most observers, maybe even to those inside of the company. Why is it not being seen as a positive in the market that Plank is coming back?
I think we all have memories of how Kevin ran the business, really between I think it was like 2015 and 2019. It was prior to COVID. It was when Sports Chalet and Sports Authority went out of business, and rather than pulling back, he wanted to keep driving top line sales and opened up distribution with product from that was supposed to go to Sports Authority and Sports Chalet into Kohl's, and then that product tripped on the product that was at Dick's and Hibbett and a few other retailers, which caused, and then the same item started being sold at different price points and so on. So it was a lot of try to drive top line at the expense of brand. And so we're not really sure what happened and why she's leaving, because as I wrote in my note, I think that she was setting the table for some very good stuff over the long term.
Yes, you're kind of going where I was going to lead you, Sam, which is, she was there a relatively short period of time, but do you think while she was there, she had the right plan, the right strategy in place, Sam?
I do. I mean, it looked like it was working. I just don't think it was given a chance. So I can have a lot of guesses as to what I think happened, but unfortunately for the timing of this, they're going into their quiet period next week. So we're not going to hear from Kevin until the beginning of May, which I think leaves everybody that's why I downgraded it. Not really because it's necessarily bad, but it's, based on what we know from the past and what we know that's going on right now, it sort of leaves, it sort of left us in a never land just trying to get more information. And it's hard to think that they were pleased with what was going on if this change was made. So it's a wait, as I wrote in my note, it's a wait and see kind of thing.
Do you think that this was, you wrote in your note as well that this was described as a mutual decision. A, do you believe that? And B, do you think that this was a move? This would not be the first situation in which we've seen a founder, ex-CEO, step back in, maybe not be as patient with one of his predecessors. Plank has already done this before. So,
yeah,
what do you think?
Look, I wrote what I wanted to write. What I can say is that that's what I've tried to figure out exactly what happened. So, but what I can say is it was sort of complicated because Kevin was the head of product who reported to Stephanie as the CEO. But then she reported to Kevin as the executive chairman. So it's sort of like a weird, it was a difficult way to run it when, she was responsible for one thing, but then she had to report to Kevin on another. And that was, that was a head scratcher almost to begin with.
And so, Sam, the baton now, though, has been handed off, right? Kevin Plank back in charge. What do you think, Sam? You know this company very well, this brand very well. What should be Plank's priorities?
Strengthening the brand and not trying to force top-line growth, because whenever you try to force top-line growth, most of the time bad things happen. You put too much, you think you can sell more than you actually can. Too much supply gets in the marketplace and the markdowns start. I think, they have to continue to evolve the product, and they're making progress, and then seed the marketplace until they can create demand and people, saying, give me that product. And again, the table looked like it was being set for that.
Sam, always good to see you. Thanks so much for joining the show and helping us try and sort this one out.
Thanks very much. Have a great one.
Microsoft moving into record territory as JP Morgan publishing an upbeat note. Shares bouncing after analysts reiterated their overweight rating on the software giant, seeing they see clear opportunities in the AI security space. So this was interesting, Julie. So Microsoft moving higher in today's trade, hits highest level on record. There is news around the company's so-called secure event, which mostly focused on a tool called Copilot for security. It sounds like there were kind of updates on availability, use cases, monetization, and the team at JP Morgan checked out the event, liked what they heard. Bottom line, said they're positive on Microsoft's kind of opportunity in the security space. Yes, they say monetization of these products and other kind of similar Copilot tools. They acknowledge it's going to be gradual, but clearly they remain long-term bullish, outperform target 440.
So I guess they had released this Copilot for security a year ago, sort of as a pilot. Forgive the repeat there, Copilot pilot. And now they're doing this broader release. And a couple of things stood out to me. You know, how is this thing being used? It basically sounds like it's helping cybersecurity professionals be more efficient, see threats better. And there's something that stood out to me in JP Morgan's note, because as we talk about AI, right, we always want more concrete information about how it's being used. So this is what Microsoft, JP Morgan highlighted from Microsoft. And Microsoft said experienced security analysts were 22% faster and 7% more accurate across all tasks with that Copilot product. 97% said they want to use it the next time they do the same task. Now, and that's for experienced analysts. JP Morgan says the number must certainly be higher for more junior analysts. So that's, I mean, if those are accurate numbers, those are pretty impressive numbers.
Yeah, and I think broadly, it's, it's kind of part and parcel what we see CEO Satya Nadella kind of doing here, right? Just integrating his portfolio with his AI tools, hopefully get more customers excited by those subscriptions.
Yeah, so we'll see what happens there, but obviously the stock is moving up today. And we want to get another call today. This time is actually, of course, sort of a collection of calls, this time from Truist, who says some machinery stocks could be in for some upside moves in the months to come. Analyst Jamie Cook today launching coverage of 9 companies, rating Caterpillar, Deere, Agco a buy, among others here, and saying that growth in the sector could surprise folks in the second half of the year in a positive way. She wrote, the group's in a unique situation. Earnings are proving more resilient despite channel destocking, she wrote, and softening demand trends, and that's helped by backlogs near record levels.
Yeah, you look at some of these names, Julie, there hasn't been a ton of investor enthusiasm for at least some of them, but of course, listen, for a bull, that's a great entry point. I thought her take here was interesting too, kind of looking ahead, she says, constructive on the group, as she believes broad-based industrial growth could surprise on the upside in the second half of this year. We'll see.
Yeah, and she's got some pretty lofty price targets for these guys. We want to take a quick check of the markets here as we see stocks near session lows right now. We continue to see the interest rate sensitive groups really weighing the most on the major averages. As we mentioned earlier, real estate, utilities, financials, consumer staples are falling the most. We've got energy to the upside, but otherwise really seeing stocks sort of drift lower as the day goes on. Still to come on market domination, we're checking in on some of the top trending tickers of the day, including shares of Lithium Americas. They're bucking the downtrend in a big way. We'll chat that and much more on the other side. New data on wholesale inflation showed prices rising more than expected last month. A separate report on retail sales rose less than forecast. Together, they make the path to potential rate cuts more complicated for the Fed. And here to help us break down the data and its implications, we're bringing in Interactive Broker senior economist Jose Torres. Jose, it's good to see you. So, I know there's always the caution against just looking at a handful of data points and trying to extrapolate what the Fed is going to do. And certainly the Fed is looking at the 6 months trends in data. So how should we read what we've been getting for January and February?
Thanks for having me, Julie. Well, January and February, what we've been getting is goods and commodities reversing their progress from last year. Goods and commodities deflation paved much of the disinflationary trend last year, but now they're starting to reverse higher. You have oil at around $81. Copper made one-year highs yesterday, so did lumber. We're seeing commodity prices increase. We're seeing goods transportation costs increase, and services never really cooperated. That remains hot as well. So what we're seeing is in the beginning of the year, investors expected 7 rate cuts. Now they're expecting 3. And as these hot data continue to come in, they're incrementally delaying the Fed's first rate cut and extending our journey across the risky monetary policy bridge.
Do you think, Jose, I mean, it is interesting to hear, some smart strategists out there who are saying maybe no cuts, Jose. I'm thinking of Dr. Ed Yardeni, who's saying, he still expects 2 cuts, but he did see an increasing chance, he's telling clients, of no cuts, just given what he's seeing with these kind of financial conditions easing the way they are.
Absolutely. The economy is doing just fine. The Fed has a dual mandate of maximum employment and stable prices. And the employment side of the mandate is not under threat at all. Right now, it's inflation that's, sticking there at right around 3%. CPI bottomed last June at 3%. We haven't seen a reading below that since. The economy is doing fine. Financial stability concerns have been placed at bay. The employment market is doing great. We have strong job openings. We have wage gains. We have good job growth. So there's really, unless inflation starts to reduce more significantly or the job market begins to weaken, there's really no reason for the Fed to cut here.
And what is your take on the effect on consumer spending? Because obviously we've seen consumer spending hold up pretty well, retail sales today being a little lackluster notwithstanding. But we also have heard just a drumbeat of negative sentiment related to inflation, even if it's moderating, still obviously prices being considerably higher than they were a couple of years ago. Does that start to pinch consumer spending at some point?
Julie, I don't think so, because what the consumer is doing is the propensity to save has been reduced. There is not as much of an incentive to save for big ticket items because of rates being elevated. Also, there's not an incentive to save for down payments because home prices are really elevated alongside rates. So what consumers are doing, instead of saving, they're spending almost all of their money, and that's really fueling consumer spending, particularly in the services segments. As far as sentiment being negative, there is an offsetting factor there, and the fact is consumers have plentiful job opportunities out there. They can go out, they can bargain for better wages, they can ask for increases. In the ADP survey, we see that the gap between job stayers and job changers is still very wide. So those dynamics tell me that the consumer, albeit they are pressured by reduced credit availability, higher prices, and higher rates, they're still doing all right. And also rents are, softening. Not as fast as I think the consensus thinks, but rents are softening, so that's good news as well for the consumer.
So, Jose, given that view on the consumer, then are you in the soft landing camp? So inflation, you think, returns to 2% without a downturn?
Josh, sometimes I wonder if the Fed is going to accept inflation at around 2.7, 2.8%, right? And before we saw inflation up in the 8s and the 9s, so 2.8 may not seem like much, but remember, it's still 40% above target. And I think that's really the difference, Josh, between whether we get a soft landing or a hard landing. If the Fed really tries to go to the end with inflation, it doesn't look like they are. So right now, I'm in the soft landing camp.
Jose, good to see you. Thanks so much.
Thank you.
Well, shares of the German conglomerate Bayer, or Bayer, have tumbled by more than 50% over the past year. That's in part because of thousands of lawsuits claiming cancer risk tied to Roundup weed killer. It's a product that Bayer acquired as part of its purchase of Monsanto back in 2016. And Bayer has been taking steps to streamline the business and try to look beyond that litigation. CEO Bill Anderson recently said that now is not the time to break up the company. That's something some investors have been calling for. And Bill Anderson, the Bayer CEO, is joining us now to discuss, as we talked about, it's Bayer here in the U.S., it's Bayer in Europe, same company, just so folks know what we're talking about. Bill, thank you so much for being here.
Yeah, great to be here.
So for investors who are looking at the company and looking at the long term that you've talked about, where is the growth going to come from? You have three main business lines in terms of crop sciences, pharmaceuticals, consumer. Where should they be looking for growth?
Yeah, there's two really obvious places. One is our crop science business. We're the world leader in agricultural inputs. So we sell our inputs to the farmers, they grow the food, and we all get to eat it, right? So yeah, we're the world leader in R&D in agriculture as well. And we're growing above the core rate of growth there. Last year, our core business in agriculture grew 7%, and we expect to keep growing faster than the market based on, 10 new blockbusters that we're launching over the next decade, including right now we're launching short stature corn, which is going to change the look of cornfields forever. That's the most obvious thing you see, but having shorter corn allows you basically to grow more corn on the land and to avoid that the corn gets blown over by heavy winds. And so it's great for farmers, it's great for food prices. Also, consumer products, our consumer products division has had very steady growth, continues to grow faster than that market, and that looks to continue as well. In pharmaceuticals, we're in a bit of a transition phase. We've got a couple major medicines that are losing patent protection over the next few years. And so we're busy rebuilding the pipeline right now. So that's not so much a growth story today, but we look to return to growth in the second part of the decade.
And as you're kind of rebuilding that pharma pipeline, Bill, is that, any more clarity there? Is that R&D? Is it acquisitions, both?
It's going to be some selective acquisitions, but more on the earlier end. The simple fact of the matter, and you see every day large pharma companies trying to buy late stage or in-market products. The challenge with that is you generally have to pay more than they're worth. And call me old-fashioned, but I don't like to pay more than something's worth. We do deals typically in phase 0, phase 1, and then we have a very effective development engine, and we can accelerate development. It means you have to be a little more patient. So we're definitely more for the patient investor.
That's because in the meantime you are dealing with this litigation risk. And I wonder if you can talk investors through whether you feel you've adequately provisioned for the eventual costs of that litigation.
Yeah, I mean, it's a complicated topic because you can only provision for things that are relatively certain to occur. Given that, we think we've adequately provisioned, and we test that every quarter with our auditors. The key thing on litigation is we've been fighting it out in the courts, and we win more than we lose, but the losses, at least the headline figures, can be quite large. I mean, we generally get damages reduced more than 90% on appeal, but the fundamental fact is that glyphosate, Roundup, is safe. Every regulatory agency in the world has concluded that, including the US EPA, including the European Food Safety Authority. And we're also pursuing, beyond the courts, we're pursuing legislation to clarify that, because it just doesn't make sense in our country, and this is really a uniquely American problem, that manufacturers can be sued when we have a safe product and it's clear in our label. So this is something that we're definitely escalating the work in this area from a litigation standpoint, but also from a legislation and public affairs standpoint. This is bad for American consumers. I know you've been talking about inflation today. So 30 years ago, Americans paid 11% of their paycheck for food every month, okay? Up until about 5 years ago, that had dropped from 11 down to 7%. Today, it's 11 again. So dramatic food inflation, and everyone sees it when they go to the grocery store. And our products keep food inflation in check, But the litigation is driving costs up for farmers, and this shows up in the food prices.
And Bill, if you had more clarity, though, on the litigation, if you got that clarity, would those strategic options perhaps be back on the table, selling or spinning off businesses?
Yeah, the way we look at it is right now we have some challenges that we mentioned. We got to rebuild our pharma pipeline. We need to deal with litigation. This is not a good time to be sort of breaking up the firm. There's a compelling argument for pure play companies, and we have we have 3 divisions. We're implementing a new system for running the company that puts decision making in the hands of the people doing the work. It's a radical thing. I mean, we're taking out not taking out a layer of management. We're cutting layers of management in half in many places. Span of control goes from 5 or 7 to like 20. Okay, it's a very different model. This is something I've been doing for about 7 years. It can lead to dramatically improved results. We're going to do this and focus really hard on it for the next 2 to 3 years, and then we're going to come back to that subject and say, hey, have we earned the right to claim our own destiny by creating, a highly efficient and effective economic machine?
Bill, when you look at those changes you've been making internally in the company, it's something you guys call dynamic shared ownership. Combine that with the glyphosate sort of overhang. Like, what's the vibe like inside the company? How hard is it to change the culture? How are people feeling with, that's a lot of change in a short period of time.
Yeah, well, obviously the litigation is very frustrating to everyone because people just feel like it's not fair. It doesn't make sense. We're a scientifically driven company, and we have this litigation thing that's not scientific. That being said, people have, I would say, a spirit of wanting to serve the mission. And our mission is health for all, hunger for none, because we're in healthcare and agriculture. And the morale inside the company is remarkably strong. It amazes me. I think it's a testament to the human spirit. But it's also because, as I mentioned, we're putting decision-making with the people doing the work.
So that's been well received.
That's very well received. In fact, most employees are saying, hey, how fast can we do this? I want this. And I experienced this in my previous jobs. When you put decision-making in the hands of the people that are doing the work, that's a novel phenomenon in a big corporation. And they like it because they're responsible people. They want to have a bigger impact. They don't want to be stuck in a hierarchy with the boss having to approve everything.
Mm-hmm. Bill, thanks so much. Bill Anderson of Bayer. Thank you so much. Appreciate it. Well, let's turn now to some of the day's trending tickers as we draw close to the closing bell on Wall Street. Shares of Lithium Americas getting a boost. The company receiving a conditional commitment from the Energy Department for a loan worth $2.25 billion. Lithium Americas is going to use that loan for financing its Thacker Pass construction plan amid its electrification efforts. And this is, obviously, it's benefiting the stock today, which is trading higher by a little more than 5%. I mean, there's a lot at stake here because of the demand for lithium and because of the U.S. reliance on Chinese lithium. So this is a step in the direction of, sort of reshoring or creating that native industry.
Yeah, I mean, used in EV batteries, solar panels, wind turbines, you name it. There was some drama around this one, Julie, which is interesting. You had tribal groups, you had environmentalists. They were not happy about this. She went to court, argued it threatened the surrounding landscape, but they were unsuccessful there. To your point, it does sound like, listen, bottom line, this is about securing a domestic supply chain.
Right, exactly. Our Ines Ferre has covered the lithium industry and is digging into this story today. Ines, what else can you tell us about this loan and how significant it is?
Yeah, it's very significant. In fact, it's the biggest U.S. lithium project when it comes to this processing plant that will be paid for by this loan. The majority of the loan or the loan will pay for the majority of the processing plant that will go in Nevada. And that's significant because processing is one of the things that China has a real stronghold on, refining, processing lithium, and they are years ahead of the U.S. in this. So it's significant that this will be used for processing lithium. And this lithium, of course, once it's processed, will be used for battery cells, as you guys were just mentioning. And it's significant also because the automakers, because of the Inflation Reduction Act and that $7,500 credit for EVs, well, that credit is only if the battery components are made in countries that are not foreign entity of concern, and that would include China. So what's happening is that you've got these automakers that are now reshuffling where they will be getting their lithium from. So it's significant for the industry as a whole. It's also significant at the timing of this, of course, because the lithium market, as one lithium player told me, we're in a bear market right now. So the fact that this is coming now, look, these projects take years to complete. This plant will take about 3 years to complete. They're hoping that by 2028, they'll be in full operation, guys.
All right, we will keep tracking it. Thanks so much, Inez. Appreciate it.
Thank you.
And another trending ticker we're tracking, UiPath, topping Wall Street estimates in the fourth quarter. Revenue guidance for the first quarter did miss expectations, and the stock is down about 7% today, although pretty much all of the analyst commentary I saw was pretty positive on this one. Yes, the first quarter forecast is a little bit short, but the full year forecast is above estimates here. I did see one comment from Bloomberg Intelligence that subscription gains were a little bit softer than estimated, but
and they
otherwise,
would say maybe in part due to competition, they pointed out.
But otherwise, this automation software company down, it's a little bit of a head scratcher.
It was interesting. You saw this like an initial pop and then a drop. But to your point, when you look through the analyst commentary, Julie, JP Morgan actually upgraded this name to overweight. Target went to 28. They talked about what they said was a long runway ahead for adoption in the broader automation market. So it'll be interesting how this one shakes out. You know, it is in the red today and in year to date. It's also though had a big jump over the past 12 months as well.
Yeah, even though it's kind of slumped now this year.
Yep. Inflation continues to weigh on American households. Coming up, we're taking a look at which retailers are best positioned to benefit from consumers making trade-offs.
One of the biggest moves in the market today, oil prices topping $80 a barrel. Jared Blickery's in the newsroom with the details. It's been on a run.
It is. Oil, WTI specifically above $80 a barrel is a big deal. And I'm going to show you why on the Wi-Fi Interactive behind me. This is today's price action, but I'm going to broaden this out to over the last 3 years. This, by the way, this spike here, that was the Russia invasion of Ukraine. This is Gaza, Israel here, a much smaller bump. But you can see we're relatively low in this 2 or 3 year trading range. And in fact, $82 is more of a resistance level that I'm paying attention to. But if oil breaks above that, we have this high here in the low 90s, and then, $100 a big round target. Point is that oil is on the upswing here. You can also see that embedded in the Brent prices, a few dollars more, $85 a barrel. All of this has to do, and it all ties back to inflation. Now, we got the PPI, that's producer price inflation number this morning, and they were a little bit hot. And let me show you the correlation between crude oil and inflation expectations. Not this one here, it's gonna be this one. This is something called break-evens. It's a part of the bond market. So you look at 10-year break-evens, which closely track inflation expectations. Those closely track crude oil prices. If we have crude oil heading higher, guess what? We probably have inflation expectations heading higher as well. And we know that what that means for the economy and the Fed. You can do the calculations there. Just want to throw out one more thing. We have AI getting into the business of crude oil exploration in the Permian Basin. If they can use AI to increase their throughput, I would be very impressed. But just another reason to suspect that AI is probably going to change everything, though not immediately.
Jared, thank you so much. Appreciate it. Now, with just over 10 minutes to go to the closing bell, we're looking at how to navigate the big picture with the Yahoo Finance Playbook. Consumers are continuing to cut back on spending. That's thanks to persistent inflationary pressure. In today's playbook, we're taking a look at the discount names that are best positioned to benefit from the lower income shoppers trade down. We're joined now by Corey Tarlow, Jefferies Senior Vice President Equity Research, and Brian Mulberry, Zacks Investment Management Client Portfolio Manager. Guys, it's good to have both of you on the show. And maybe, Corey, I'll start with you. You've gone through a lot of earnings reports now, Corey. You've listened to a lot of conference calls. What's your take on the kind of low-income consumer right now, Corey? How healthy and resilient do they look, just based on what you're hearing from your own coverage universe?
Good afternoon, and thanks for having me. So what I would say is that right now, the low-income consumer has clearly been pressured by the persistent inflation that we've seen. And the individual who was on before me cited that oil could be breaking higher. Well, one of the things that you monitor and you think about when it comes to dollar stores is, especially when it crosses that $4 a gallon threshold, you do tend to see traffic pick up at the dollar stores. And so as you have seen really robust inflation cooling some, but still sticky, potentially oil prices going up, it does spell for a consumer that is still very value conscious. We are starting to see some early signs of improvement in general merchandise at certain retailers, but it's still very, very early days there. So you're still seeing a prioritization of needs over wants.
Brian, I want to get your take on this as well, and whether, it feels like when you're talking about a Dollar General, Dollar Tree, Family Dollar, the trade down sort of stops there, right? So it would just be people not buying as many discretionary items or buying less of what they're buying. Kind of where are we in that cycle in your view?
Yeah, absolutely. And I'll add to the discussion where we find a clear dividing line for the consumer is whether or not you own your own home. Those people that owned a home and were able to refinance at a very low fixed rate aren't feeling the pinch of inflation as much as those people who have been renting since 2020. They're feeling everything. Rents are up 12 to 20% nationwide. Now we've got energy costs rising on the back of insurance costs rising, and that's really causing a change in the behavior from consumers where they're having to go and save money somewhere else. And so we're looking at these stores and their product offering. And Dollar General in particular is one of those places that has really made a key investment in perishables where you could actually get some fresh produce while you're there shopping for other items at a discount as well. And so that's really a big part of their growth, is to have more engagement for people who are already there trying to save money in their budget because of the higher cost of everything right now.
And Corey, I want to bring you here as well because you cover those names, and it was interesting, Corey, to watch. I mean, Dollar General reports, gives an outlook. Investors clearly liked it. Dollar Tree reports and tanks. You know, Brian touched on it, but I want your take, Corey, as well. What do you think kind of explains the diverging stories there?
Yeah, it's a tale of two businesses. I think at Dollar Tree, it's certainly a tale of two banners as well. For me, at Dollar General, it's all about traffic and market share gains. Dollar General has seen traffic increase in the last 2 quarters consecutively. They've seen market share gains in consumables in both units and dollars, and market share gains in dollars in non-consumables. So everything seems to be trending in a good direction there from a sales perspective. And then as we go to Dollar Tree, as I mentioned, it's a tale of two banners. The Dollar Tree banner continues to be very, very strong from a sales and margin standpoint. However, if you look at the Family Dollar banner, the Family Dollar banner has been very pressured from a profitability standpoint. And in fact, in the last quarter, it only generated $7 million of operating profit on a business that is multi-billion dollars in revenue. So that profit outlook for Family Dollar does give us pause when it comes to Dollar Tree.
And so, Brian, is it as simple as for investors to avoid Dollar Tree and maybe deploy some capital to Dollar General?
Well, and I agree with what Corey's saying. And then if I take it a step further and look at the forward guidance, you've got Dollar General who's looking to grow their footprint, expanding aggressively, remodeling stores, and also adding to their lineup in terms of available product. This is a good growth type of story. Whereas with Dollar Tree, they're cutting, right? They're going to end up closing around 1,000 locations of those Family Dollar stores. And that seems like a business that's in decline just from the top end of it. As we dig into the numbers, also agree that there's good profitability there, but how do we go forward from here? And for us, in the rising expense that we just saw from the PPI data, right, input costs might not be as rosy as people think, especially with oil going higher. So now it becomes to operational execution. We know that there are cost savings out there, that there could be more efficiencies gained. It seems like Dollar General to us is in a better place in terms of controlling those expenses and having better margins from this point going forward. There will be some cost savings from the restructuring from Dollar Tree eventually, but they kind of have to right the ship in the near term.
And Corey, I know you agree at least with some of Brian's points though, because on Dollar General, you know, you're a believer, you got to buy on that name. Dollar Tree though, you're on the sidelines, Corey. So what do you need to see before getting more bullish on that name?
I think it comes down to profitability. And ultimately, if you think about the path for Dollar Tree, the Family Dollar segment, with all the closures that were just pointed out that are occurring, again, about 1,000 stores, that's going to be over $700 million of revenue that is going to be lost due to the closure of these stores over time. And so that's a very sizable portion of the company's sales that are basically going to disappear with these closures as they slowly try to inch toward a more profitable enterprise over time. And so this is really going to be a show me type story for Dollar Tree, and it really needs to start, in our view, with an improvement in Family Dollar.
And there's one other retailer that I want to bring up with you, Brian, in particular, because I know you're watching, and it's one we haven't heard from yet in terms of earnings. That's Five Below, also in the discount space. It's a little bit different here, right, in terms of its profile, in terms of what it sells. My kids love going in that place, by the way. But how is it going to stand up versus these other ones?
Well, Five Below has a little bit different model, right? They're attached to some bigger mall type of footprints and larger store sizes, and they have a little bit more flexibility rather than tying themselves to just $1, right? It's $5 and below, and there's actually quite a few things in there that we know are well above $5. So they've got more price flexibility from just a consumer expectation point of view, and they certainly are targeting the preteen and teen market. I know my kids love going there as well, but it simply lacks the scale, right? We're talking about a business that only has about 1,500 locations compared to Dollar General at over 5,000. And just in terms of sheer scale of revenue, we're talking $3 billion or so in sales compared to the $38 billion in Dollar General. And so they definitely have more growthier type of a feel, but they're not quite knocking on the door of Dollar Tree or Dollar General just yet. But there is a clear I would say, momentum behind the growth. The lower numbers mean that there's more energy behind some of the wins in terms of earnings beat and earnings expectations. And they certainly have a good business model because they're not carrying any debt on the balance sheet right now.
Brian, Corey, thank you both guys for joining us today. Appreciate it.
Thank you.
Stocks bouncing off the lows of the day here. Look at the Dow's down about 0.4%, S&P 500 down about the same, Nasdaq down also about 0.4%. So right across the stream for all major averages. But don't go anywhere. We've got you covered with all the action following the closing bell, including earnings from Adobe and Ulta. Stay tuned for market domination overtime.
There's the closing bell on Wall Street, and now it is market domination overtime. Josh and I joined by Jared Blickery to get you up to speed on the action from today's session. So let's see where the major averages ended up. We did end up off the lows of the session to some extent. For the Dow, down 137 points, about 0.4%. The S&P 500 also cutting its declines about in half, off about 0.25%, and the Nasdaq finishing down by 0.3%. You know, amidst all of this talk about broadening, it's worth noting today that the more broad representations of the market actually did worse. And this is something that Jared Blickery flagged to me just a little while ago. For example, here, the S&P equal weight index down 1.25%. And if you take it back and look at the past couple of months, today's decline that we saw was the worst than we've seen in about a month's time, both for that equal weight index and for the Russell 2000, which is another area that a lot of investors have been highlighting as something they like. hike. It was down 2.4% today. So also, let's see here, the worst in a little more than a month's time, it looks like. So interesting to see that action. And Jared, I'm going to send it over to you. Thanks for flagging those.
Hey, thank you, Julie, and thanks for that explanation. It's interesting. The Russell 2000 and the S&P 500 equal weight, very closely correlated when they have big down days, like today. Now, in sector action, all we have is energy and tech in the green. Tech just barely. That's XLK. Energy taking the top spot, just went over crude oil. WTI holding above 81, Brent holding above 85. That's a big deal. But here's real estate. Real estate, the worst sector of the day, worst performing sector of the day, followed by finance and utilities and staples. Each of those down about 7/8%. And as you can see, it was a largely negative day. Now, here's my leaders and sentiment page, and you can see everything in the red right now. Leading to the downside is Bitcoin. Bitcoin very volatile, leads to the upside on this board many days, and today to the downside. After that, ARC components. So the disruption trade got hit particularly bad.
Jared, I'll take it from there. Let's talk Apple for a second here, because we got some interesting news today about Tim Cook's company. They typically do not talk about acquisitions, but they are actually pretty active. They usually acquire smaller companies. That is what happened now. Bloomberg reporting that Apple has bought a Canadian AI startup called Darwin AI, which makes AI systems smaller and faster. And Bloomberg, of course, pointing out that could be useful as Apple's more focused on running AI on devices rather than in the cloud. We know some investors, of course, have been kind of questioning Apple's AI strategy. The feeling is maybe they're falling behind in this Gen AI arms race, though Tim Cook, Julie, has said Apple will break new ground in AI this year.
Maybe it will. I don't know. We'll see. But it's interesting what this company does in particular. It's focused on making AI tech smaller and faster, according to this report. And, these things are pretty small, and we want them to be pretty fast. So maybe that's what's
Well, you could, I know, obviously investors have been skeptical about Apple's AI strategy, but you could also argue, listen, as AI kind of moves from the cloud to the edge to these, Tim Cook, hardware, software, controls the chips, could be in a good position. We'll see what he says.
We will see. Yeah. There's been a lot of suspense over these issues. All right, joining us now with her top takeaways from the trading day is Yahoo Finance's Shauna Smith, host of The Morning Brief. And one of the things that you've been watching today is something I've been watching very closely too, which is the 10-year yield, which has had a big move today on the back of economic data.
Yeah, huge move to the upside. The biggest one-day pop actually that we've seen in just about a month. And it was on the heels of that PPI print that we got out just before the bell this morning. And the reason why we're seeing such a reaction play out within the Treasury market, within the bond market today, is just because it shows how nervous the market is about Fed policy and exactly what the Fed's plan for rate cuts is going to look like later this year. When you take a look at those expectations right now, we know the market's pricing in 3 cuts before the end of the year. When you take a look at the Fed swaps right now, they seem to be pushing out that first cut. It might not be until July. And we're going to get the dot plot just next week. And so I think so much is going to be riding on what exactly that tells us about the Fed cut, about the timing of that Fed cut. And because of that, we're seeing this massive move in yields once again. I also want to point out that this isn't exactly unusual. We have seen this over the last couple of big data releases that we've gotten over the last couple of weeks. So earlier this week, when that CPI print was released, we did see also a big reaction in the bond market. And then also going back to the jobs data as well. And so it gets me back to the point of the market clearly very jittery and very much on edge about what the next move is going to be from the Fed.
Yeah, it's also, we were talking earlier today, Sean, too, about how many, some pretty notable economists saying the market's got it wrong. There aren't cuts coming. I mean, first you were from Apollo, Torsten Slok over there. And then I was struck by even Dr. Ed Yardeni saying, I mean, listen, I don't want to overstate it because his base case is still 2 cuts, but it was just interesting him telling clients, listen, increasing chances, no cuts in his opinion.
It is. And then you also square that with strategists out there who are still very optimistic that we could even be getting more cuts than what the market is pricing in. We had Ryan Dietrich on earlier today, and he was saying that he still thinks there's a 30 to 40% probability that the Fed could cut rates in May. So he's not even talking about June. He's talking about May. So clearly much more optimistic, if you want to look at it like that, than what the market is currently pricing in, and of course what the bond market is telling us. But there are very firm believers on both sides of this argument.
Yeah, and then the other thing, of course, that you're watching that we've been talking a lot about is sort of the breakup of the Magnificent Seven. And I know Jared wrote about it again in this morning's morning brief. And we've seen some notable laggards there.
We have, and you were just talking about earlier here at the top of the hour, just about the underperformance that we saw in the S&P equal weight. And we started talking about the broadening out of the market action that we had been seeing over the last several trading days. When you take a look at that, clearly not playing out today. And then even within the Mag 7, some of the leaders of last year also under pressure in today's market action. So this all gets tied together back to what I was talking about at the top there, just about the thought of the delaying a rate cut, and that could potentially slow down this market rally. Now, Tesla, it's closed off 4% today. That's a very stock-specific story, right? This isn't anything different than what we've been talking about over the last several weeks. Clearly, the stock off pretty big since the start of the year, off just about 30%. Another analyst, UBS, lowering their outlook on Tesla, so that's weighing down Tesla. But Nvidia is an interesting one, right? It has certainly been a very wild couple of days for Nvidia. We know a lot of the focus is going to be on the investor conference next week and exactly what is going to be unveiled there. So we're seeing some choppy action there. And of course, you can make the argument that is nothing to be too concerned about given the massive run-up that we've seen in
It's interesting in Nvidia, you got the big AI show,
Yeah.
right? A lot of tension there. But Tesla, I actually don't know what a near-term catalyst would be. I mean, if the issue is like slowing EV demand, it's just interesting. You'll hear bulls say, long-term, it's energy storage, of course. They'll get into, automation, right? But I don't know near-term what they're counting on.
I don't know.
Anytime talk to a bull.
The street doesn't either.
Yeah. And the other thing that you're looking at today, oil prices.
Oil. So this is the standout. So I wanted to end on something positive here and take a look at energy and how that performed today. The only S&P sector here to eke out gains, up just about 0.7%. That riding on the back of the rally that we have seen in crude. We've got prices closing at the highest level that we've seen in just about 4 months. There was new supply data out today showing that supply is expected to lag this year. Stockpiles are starting to dwindle. So you square that with the geopolitical risk aspect of this, with the drone attacks on Russian refineries. That is pushing the price of crude to the upside. And because of that, you have a lot of the larger energy plays that have actually eked down some of these gains are back in favor with investors. Exxon, Chevron, among the names here closing in the green, up just about 1%. Exxon the leader there. And then also you have a name like Diamondback Energy trading at an all-time high.
Thanks a lot, Shauna. Appreciate it. We got some breaking earnings news from Adobe. The numbers just hitting the wire here. And the company, it looks like earnings per share ahead of analyst estimates, revenue ahead of analyst estimates, a $25 billion stock repurchase program. So why, you might ask, are the shares lower? Well, it looks like the second quarter forecast is what's to blame here. So let's go through the numbers here. That was sort of the top line headlines here. First quarter adjusted earnings per share, $4.48, 10 cents ahead of estimates. Revenue rising 11% quarter over quarter here and also ahead of analyst estimates. But the company's forecast for the second quarter revenue is at most $5.3 billion. Analysts have been looking for $5.31 billion. And specifically in its digital media business, which is the larger part of its business, seeing revenue of at most $3.9 billion in the second quarter. Again, there a slight shortfall to the $3.91 billion that analysts had been anticipating, and the $25 billion stock buyback authorization, not enough of a carrot, if you will, to cushion the blow perhaps of that forecast. The other thing I noticed here, even as Shantanu Narayan, who is the chair and CEO in the statement, talks about the strong momentum, harnessing the power of generative AI. I did look for the word Firefly, which I'm sure will come up on the call. That is their generative AI product, but not mentioned at least yet in the statement.
Yeah, it's interesting because this stock, obviously lower here, at least initially in the after hours, it was already in the red this year heading into the print, Julie. At least one thing, we know one big thing investors have been concerned about is Adobe and whether it's actually going to benefit or be disadvantaged in this new AI era. This idea there's going to be, there are and will be new AI tools that's going to commoditize the platform. Not everybody, of course, believes that, including a very smart financial analyst we'll be talking to shortly who covers Adobe.
Yeah, and there have been certainly some defenders of the stock for sure. But yeah, there are a lot of questions. And there were also some recent reports that its generative AI software suffered from some of the same issues, if you will, as some of Google's generative AI image generation software, in particular, sort of, historical images that didn't make sense, for example, that were generated on the part of Qs. So, still a lot of questions about some of these products.
Meanwhile, the market's under pressure today, but year to date, we've seen all three major indexes reach record levels, with the S&P already blowing past some street estimates thanks to a solid earnings quarter and the AI rally. There's been talk of a bubble, we know, popping at some point, but our next guest believes there's still more room to run. Eric Friedman is the U.S. Bank Asset Management Group's CIO. Eric, it's good to have you on the show. So maybe we just start there, because that's certainly a question that's been raised, Eric. You know, people, they've been looking at Nvidia and this AI rally, and you're hearing these questions. Maybe we're seeing a bubble, but you don't think that. Things don't look bubbly to you.
They don't. And Josh, thanks so much for having us on. Look, as someone who lived in San Francisco during the dot-com rise and fall, maybe I'm a bit jaded by what a real bubble looks like. We think there's just a really tight supply of services in AI right now. Specifically, if you look at the core producers, the OEMs, if you will, they just can't get product out fast enough. And so we do think that demand will be steady. And if you also look at what backs up this AI move, it is continued corporate CapEx. Companies are looking to get bigger, stronger, faster. They're not doing that through hiring more people. They're doing that through technology spend. So again, as you have constrained supply with still very steady demand, we think there's going to be an ongoing bid there. And we would, there are lots of things to fight in global macro. That's not one thing that we would pick a fight with right now.
And so not picking a fight and sort of investing more in it are two different things, right? So would you put more money to work in that theme right now?
Yeah, Julie, I think as things settle back, and if we do see a retrenchment, you know, even all the areas that you've talked about, whether that's equal weight or small cap or certainly AI space, we think there is room to run. So this is very much an interest rate driven story in the near term. And we have right now in front of us a really important technical level. Shauna did a nice job of covering this in the prior segment. But as we get closer to 435 in the 10-year, that begets 4.5%. 4.5% is a very, very key level for both the Fed to issue more concrete guidance. We'll certainly get those dot plots next week. But we do think that with more moderating interest rates and the bias for the Fed to cut back, we think that sets up a good opportunity to get to stay involved or get involved if you're not involved.
And Eric, for equity investors listening right now, I know you favor, it looks like, domestic over international. Sound a bit nervous there, Eric, as a lot of people are about China. I've seen some strategists on China, Eric, they kind of push back on that. I know it's kind of a contrarian call, but they say, valuation now looking attractive, but you don't see that.
You know, China has been a great excess return source for us for several months. And anytime you're underweight something, you have to have some nervousness attached to it. That's really where we are right now. There's not a great fundamental reason beyond a ton of liquidity injections from the central government. The property market is still upside down. You look at where core demand is from a consumer standpoint, it's just not there. So the reason that China is really moving up is because it's been down so much. I mean, when you're down 45%, which again has been great to be underweight, there may be a bit of a reflexive move higher. So again, it's an area where the information is not great coming from China, but the fact that you've had just such a move lower, probably a little bit of a consolidation makes sense. We'd still remain underweighted. We think there are other opportunities out there and not a great fundamental story for some time in China.
So we talked about where you do see opportunities here in the U.S. in terms of sort of the tech AI trade. I know you like consumer discretionary and healthcare as well. Just briefly, what are the sort of thinking behind those?
Yeah, I think on healthcare specifically, this is something that, Julie, there's this ongoing, let's call it demographic tailwind that's very hard to move past. In other words, you've got a broadening out of an aging population. You have more value-added services being delivered, whether that's in pharma, whether that's in things like biotech. If you look at PBMs, if you look at a variety of the service intake for healthcare, it just hasn't been rewarded. And that demographic trend we think is going to be very slow to let's call it curtail. So we think it's hard to bet against demographics. This is an aging population with still some degree of growth. So we'd stick with healthcare. Consumer discretionary, we think this is a story of the big getting bigger and really consolidating down the overall environment. So we think this is a space where you can get involved in some of the larger consumer discretionary. That is really the hub, if you will, of CapEx and the changing experience for consumers. So those are two things that we think that get bigger and continue to get stronger in both spaces.
Eric Friedman, thanks so much. Appreciate it.
Great to be here. Thank you.
Coming up, we're talking to an analyst to break down those latest numbers from Adobe. Those shares still sinking amid the earnings report. Stay tuned. More market domination overtime right after this. Adobe just reported first quarter earnings, and the stock is tumbling here, but it's tumbling more because of the forecast. Actually, I think they reported first quarter. I'm all screwed up by the fiscal year here. Alex Zukin is joining us. He can help get me straight. Wolf Research managing director and head of software research. They just reported their fiscal first quarter. It is the second quarter forecast that is to blame here for what's going on with the stock. Alex, just give us your first blush reaction, please.
Yeah, I mean, I would say the net new digital media ARR was, I think, a bit south of where people were expecting that performance to be, the outperformance against their guide. That's probably one of the key metrics. There was also no raise for the year. That was a little different than this time last year. I think the big surprise was the buyback and the size of the buyback. I think that was a question a lot of investors had after Figma. What would be next? How would they use the capital they were going to use for Figma? So it's really great to see that the company, believes in their story enough to buy back that much stock. And I think that it'll be great to hear on the call about, the generative AI strategy, the puts and takes, and how the company sees that as potentially adding to the growth opportunity, to the growth algorithm for their core business over the course of the year.
I do, Alex, I do wonder whether, this print is going to kind of generate some worries among at least some investors that, just about competition from those AI-focused startups like OpenAI. It was a worry heading into this print. And now with that forecast, maybe it'll throw some more fuel on that. What's your response to that, Alex?
I think we're going to hear a lot about that on the call itself. I think it'll be really important for Shantanu to come out and kind of remind folks that Adobe's strength is around the editing side, and all of these wonderful new pieces of content, video or image that are getting generated now for professional commercial grade distribution. You're still going to need to edit them, and the kinds of content that are able to be used are going to be super important. Understanding what data set that content is trained on, I think that's going to be super important. So I would say this doesn't really change in any way my opinion on the competition within with the foundation models themselves or diffusion model providers themselves. But I do think that the smaller outperformance than the last few quarters is certainly going to raise some questions, whether it's macro, whether it's competition, whether it's market, whether it's, by the way, seasonality, and maybe there's more goodness later in the year as more of these features are fully commercial grade and commercialized, and you're going to get to see pricing as a tailwind probably closer to the second half of this year.
Alex, I'm also curious. I mean, given that Adobe is a visual company, right? They make visual management, visual software. There was this report in Semaphore this week that their Firefly tool repeated some of the same mistakes that Google's Gemini had originally made, prompted, for example, by the reporter to show a picture of German soldiers in 1945. It showed black soldiers. So, sort of these things that are nonsensical, if you will. Is that going to be a problem for Adobe? Is that something they need to address?
I think even that article talked about how it's less of that's more of a technological limitation rather than, I think, folks embedding bias. I think the ability to take historical context and better understand and embed context for those types of inquiries, it's still very much a work in progress. I think the big difference is that for Adobe specifically, it's really part of a suite of solutions to create the best content possible via, ideating and then editing and changing and then producing and then scaling and commercializing content. So it's not as much, I think, a problem for them, because the end result ultimately is how do we, deliver the best content, not necessarily just generate it.
Alex, in terms of what's ahead, the company does have its so-called summit conference, Alex, coming up later this month. What do you expect to hear there?
I think it's going to be super important. I think it's going to be great to hear about what Adobe's doing in video diffusion model capabilities, how that's coming along. I think it's going to be really great to get an update on the newly launched Acrobat AI product that they've talked about. And look, I think ultimately we would love to get a better understanding of how the company itself views its own path to Gen AI commercialization and tailwinds for their products, specifically how folks are using Firefly within Creative Cloud, how many images they're generating, how many videos they're generating, and how ultimately that's going to reflect on the growth and earnings growth equation for Adobe over the next 2 to 3 years. And I think we'll get a lot of that hopefully at Summit.
And Alex, just quickly here, again, I know we haven't heard on the call yet more details on this, but just at first blush here, given the decline and given the decline we've seen this year, is this an opportunity for investors to get in here? Do you think they should be buying?
So I'm going to talk about without the context of the numbers, because we have to wait to see the call. But we've been advocates that this is, after Microsoft, the second best example of generative AI tailwinds inside of the product for growth for a company in enterprise software. So we absolutely believe that this is a multi-year opportunity. Adobe has a front row seat in changing this industry and benefiting from that change via growth and profitability. So we're still very bullish.
Alex, thanks so much for joining the show today. Really appreciate your time.
Thank you guys for having me.
Some good news for home buyers. Mortgage rates fallen for the second week in a row. Our own Danny Romero is here with the details. Danny.
Good news. Rates have dropped 0.25% in the last 2 weeks. So this is really good news for rate-sensitive buyers. The average 30-year fixed mortgage rate fell to 6.74%, and that's obviously lower from the previous week, which was 6.8%. But again, this also has sparked an opportunity for homeowners to refinance, and that's been good because they want to either lower their mortgage payment or lower some of their debts. So demand for refinancing has actually started to pick up in March. So that really just signals that homeowners are really aware and paying attention to these rate movements that are happening in the market. But still, only a few are really benefiting from this drop in rates. 89% of homeowners still have a rate under 6%, Redfin reported. So
they're not refinancing right now. So the other big housing news that we got was Lennar reporting, and there it wasn't quite as positive, right? We heard a warning actually from the company.
Yes, Lennar CEO Stuart Miller says that affordability is still a major headwind for buyers looking into getting into the new home market. They say their customers have a higher debt to income ratio. And remember, these home builders have been working with these customers to offer different incentives. Some of those have been the mortgage rate buy downs. Other ways have been the home price reductions, which Lennar did. They cut its average sales price, a 8% drop from last year. And some analysts have pointed to that's one of the reasons why they had total revenue for the quarter was down for Lennar. They still say that demand is really strong for housing.
All right, we'll keep watching. Danny, thank you so much. Time now for What to Watch Friday, March 15th. Starting off on the economic front, preliminary consumer sentiment data releasing in the morning. Economists forecasting a drop in February's number, but up 10% year over year. It's coming after retail sales data coming in weaker than expected, but still showing strength in consumer spending.
And sticking with the economy, a new import price index report for the month of February coming out in the morning, giving us another inflation gauge going into next week's second FOMC meeting of the year. The number expected to go down month over month, a welcome sight perhaps for the Fed. The central bank has been dealing with hotter than expected inflation data in recent weeks as it continues to steer the economy toward 2% inflation.
And finally, tune in for another episode of Yahoo Finance's Goodbye or Goodbye tomorrow at 3:30 p.m. Eastern, where we help navigate the best moves for your portfolio.
Very exciting. That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow for all of your coverage leading up to and after the closing bell. Stay tuned. More Yahoo Finance on the other side. The Federal Reserve's March meeting kicks off in less than a week, and investors will listen closely for any indication of timing on upcoming rate cuts. The central bank, since its founding more than 100 years ago, has seen its impact extend beyond just monetary policy. And that, according to our next guest, is a problem. Dan Katz, a Manhattan Institute adjunct fellow and former Treasury Department senior advisor, argues in a new report that the Fed's current structure limits its effectiveness and some significant reforms are necessary. And Dan Katz is joining us now. Thanks for being here, Dan.
It's great to be with you.
So first of all, what is the problem with the Fed, as succinctly and sort of in as plain language as you can? And is it just outside the bounds of its traditional role in monetary policy?
Well, the problem with the Fed that most people would understand it, is that we've actually had very bad monetary policy in recent years, and that's contributed to the inflation that we've had recently. And so what we've tried to do in our report is to step back and say, look, the Fed is this very special institution that's not like any other government agency. It really has very limited accountability because we're trying to insulate it from politics in the tradition of central bank independence. And so what my co-author Steve Myron and I did is we looked at the Fed's governance and we asked ourselves, what is it about the Fed's governance that contributed to the mistakes of the last few years? And are there any adjustments we should make to make the Fed perform better? And what we've found is that the Fed's lack of accountability really did contribute to many of the monetary policy errors of recent years. So the structure of the rate setting FOMC is dominated by the DC-based Board of Governors. And that has really enabled groupthink that has allowed the Fed, for example, to unilaterally reinterpret its inflation mandate in 2020 to purposefully try to overshoot its inflation target. And then for the next year and a half to dismiss inflation as transitory, which of course contributed to the inflation that resulted in declining real incomes in recent years. Additionally, sorry, go ahead.
Please, go ahead.
Well, and beyond monetary policy, the Fed's wider responsibilities have also dragged it into the political arena. Think banking regulation and crisis response. And so what we recommend in our report is a set of solutions to change the Fed's governance arrangement that we believe could help insulate the monetary policy process from political pressure and result in better monetary policy over time.
Well, it sounds like part of what you're arguing is not necessarily political pressure. It's more just the structure of the Fed internally. So, for example, when you talk about groupthink, that's not necessarily a political problem. That's just a sort of a human problem, right? So how would you correct for something like that?
Yeah, so that's exactly right. It's really about the incentives on the FOMC and what that does for the monetary policy process. And I think it's important to recognize that central bank independence does not just mean an absence of accountability, right? Accountability is a fundamental mechanism we use across society to ensure good performance. This is fundamental to corporate governance, for example. And we really believe if you want to incentivize the Fed to do better next time around, you need to inject more accountability into the process. And you also need to change the structure of the Fed to reduce the incentives for example, groupthink, and to reduce its responsibilities that are so tightly bound up in the political process that they result in the Fed being politicized. Like, for example, the current fight around bank regulation and the so-called Basel III endgame, which has the Fed, deeply enmeshed in a very, very ugly political fight in DC, which is really not helpful for the Fed to be able to conduct monetary policy independent moving forward.
So I just want to focus more on the monetary policy side of things. How do you incentivize? Well, I guess first of all, how do you incentivize better decision making, and who decides whether the decision making is good or bad? Frequently, that kind of thing is not obvious, to say the least, until it's too late or until later, right? I mean, in other words, you have a lot of arguing in real time about whether the Fed's decision making is correct or not, external arguing, that is. So how do you decide if it's right or not? And then how do you incentivize the quote unquote right decision?
Sure. So obviously no system is going to be perfect. That is the nature of dealing with uncertainty, which is an inherent feature of the economy. And so adopting, for example, a policy rule like a Taylor rule or curtailing the Fed's scope of action ex ante, we think would actually be a very big mistake, because you do need real people in the room debating ideas and trying to make the best of an uncertain future. what we focus on in the report is trying to create better incentives for decision making on the Fed by relying on checks and balances. And also by injecting additional accountability. So, for example, on the Board of Governors, what we're calling on is for a restructuring of the terms of governors to shorten their terms, to also impose cooling off periods before returning to service in the executive branch to reduce the incentives for politicized decision making, and also to allow the president to remove Fed governors for poor performance. And we would balance this increased presidential control over the Board of Governors with a revamped reserve bank system. So right now, the reserve banks basically lack complete democratic legitimacy. They're actually private corporations that are largely governed by local special interests. And so what we would do is bring them into the government formally, and we would have their leadership selected by the states in their district. And crucially, on the FOMC, we would have all the reserve banks vote at every meeting. So the idea is you balance a board of governors that's under increased presidential control with a revamped reserve bank system that is more accountable at the state level to create a check and balance throughout the system to avoid politicized decision making on the FOMC. That's not going to be perfect, but we think that an increased diversity of voices on the FOMC is going to help lead to better decision making over time.
Dan, it's very thought-provoking, and I appreciate you coming on and sharing it with us.
Thanks for having me. Great to be with you.
Thanks. Still to come, shares of Ulta Beauty are on the move in the after hours, downward about 5% following a mixed outlook for the fiscal year. We'll talk to an analyst about the latest numbers on the other side.
Taking a look at shares of Ulta Beauty, the company topping fourth quarter estimates and lifting its fiscal 2024 earnings outlook. However, the company lowering its comparable sales and operating margin forecast. Jessica Ramirez, Jane Halley, and Associates Senior Research Analyst joining us now to break down the latest results. It is good to see you on the show. And maybe just to start, get your reaction, Jessica, to this report. What'd you make of it?
Yeah, so actually, in terms of growth and what's come up, they had very tough figures to lap. So in consideration, they did come up with very positive figures. And I think overall that it's a year where we're seeing beauty, and especially with Ulta, a year to normalize. So again, I'm not surprised with the results. Again, I think they are good results, but obviously the street seems to think otherwise.
Well, and the company, among other things, is cutting its operating margin forecast for the full year. So you have to wonder here what it's spending more on, or is it not raising prices as much? I guess we'll find out more on the call, but what have you been seeing trend-wise?
Yeah, in terms of, color that we'll want to hear from the call is where is pricing going? But again, I think if we look at the lapping of year over year, they did bring in a lot of those luxury brands in. So those comparisons are very tough. Those prices were much higher. I do think this year we might see some normalizing within pricing. And in terms, they did announce they will be expanding into Mexico, which I think is great. I think that's definitely a market. Sephora is there, so it is going after its competitor. And again, they do have the beauty that it is entry-level beauty points to also prestige. So again, I think that's still a positive for them.
And Jessica, they're also clearly focused here on the international market. They are apparently forming a joint venture here to launch Ulta Beauty in Mexico next year. What do you, when you look ahead here internationally, still a lot of runway there for them?
Yeah, they're mostly located in the U.S. As I said, I think Mexico's a great market. They are in ties with Grupo, I believe it's Axel. Again, I think that market is a beauty market. The majority of beauty sales, especially in the U.S., do come from the Hispanic market. So I think it's a no-brainer to go into a market like Mexico. And as I said, Sephora has been there. So it does make it a good positioning to go after their competitor.
Jessica, it seems as though some of the current trends are not necessarily away from makeup, but skincare has obviously been a big trending area. How has Ulta done in that, considering that they also have a big makeup business? In your view, have they kept up with the skincare trend adequately?
Yeah, so they have. I think if you were to ask me a few years back, I would say they were lagging, but they really have come up to really coming through and expanding their skincare category. If you look at their skincare category, they do focus a lot on viral trends, which have been huge in skincare in terms of either Korean beauty or what they have as called as global beauty. There's a lot of interest with clinical beauty, and that's on the rise. I think the consumer is much more interested in that. And we have seen Ulta to really bring in that assortment. So when I'm looking across what is making sense with the consumer and where we see the consumer have more interest within beauty, I do see skincare being one of them. And again, they have grown that category. Sales have been up. So they have taken from cosmetics. And also, I think the most exciting part about skincare, it's something that's replenishable. So again, we do have the customer coming back to their doors to replenish such an item.
Jessica Ramirez, thanks so much. Appreciate it.
Thank you.
Well, India's entertainment industry is booming, but U.S. media companies like Paramount Global and Disney are finding it difficult to compete as local rivals sit on piles of cash while monetization efforts in the region stall. Yahoo Finance's Alexandra Canal. So excited to talk to you about this, Allie. You've been digging into this.
Yeah, so I just thought it was interesting that very recently, in the span of 2 weeks, we've seen two major media companies pull out of India. And India is an area that we've seen a lot of growth in, a lot of investments across tech. You look at a company like Apple, they're making a lot of investments over there. However, the reason why I think this is happening now is profitability is a big challenge for a lot of these companies. Paramount obviously is dealing with heavy debt debt loads, and now that they sold their entire 13% stake in Viacom18 to Reliance Industries, they're getting $517 million in cash. So that helps them de-lever their balance sheet as, M&A rumors are swirling for that company. At the same time, it's very hard to monetize in India, and I think that's why we saw Disney retreat a little bit from that company. They are going to be selling their Stars business to Reliance, and they're really creating this new joint venture. So not fully exiting India, but definitely a step back compared to what they were doing before. And Disney, they really struggled in the country after they lost the rights to stream the Indian Premier League cricket matches to Reliance. That led to a severe drop in those Hotstar subscribers, and that led to average revenue per user declining pretty rapidly. So when you have this combination where profitability is struggling back at home in the US, both of these companies dealing with a lot of challenges, now is probably not the best time to be making further investments in riskier overseas markets. That being said, though, India has very significant advances when you think about media and entertainment. There was a new EY report that the country's M&E sector grew 8% in 2023 to reach $27.9 billion in total value, and that's expected to continue to expand as the country really grows in this particular industry. So I think we're going to see investments. It's just now might not be the right time considering all the challenges.
Yeah.
Yeah, it's interesting, just given all the geopolitical tension with China, you think you'd be doubling down on India.
Yeah, and like Disney has said that they want to stay in the country, but in an earnings call in November, Bob Iger said at the time that they were evaluating all of their options because there were areas of the business that were struggling, not just for Disney, but really across the gambit when you think about all of these legacy media companies that are in that region. So I do think it's going to be an area of focus. I just think now is probably not the right time.
All right, Allie, thank you so much. Appreciate it. And coming up, shares of U.S. Steel sliding for a second day as Biden voices opposition to its planned sale to Nippon Steel Japan. We're going to chat the latest on the other side. Cleveland-Cliffs CEO reportedly considering now another bid for U.S. Steel, but at a lower price versus the existing offer from Nippon Steel. This is according to Bloomberg. Shares of U.S. Steel sliding for a second day as President Biden voicing opposition to that planned sale to Japan's Nippon Steel, while Donald Trump recently promised to block the takeover instantaneously if he wins the presidential race in November. Biden and Trump's stance on the proposed deal coming as the two candidates face the heat of election year politics. Here to discuss now all this is Yahoo Finance's very own Rick Newman. So, Rick, give us the Rick Newman take on all this.
Steelworker jobs and union jobs, I think, are the main issue here. I mean, U.S. Steel is not the titan it once was, nor is the U.S. steelmaking industry. But guess what? It operates in Pennsylvania, where it's headquartered, my hometown of Pittsburgh, by the way, where the Steelers remain named after the steel industry. And there may not be a lot of steelworker jobs left in Pennsylvania, but there are enough for President Biden to care about it because, of course, Pennsylvania is a swing state. So he basically scotched the idea that the Japanese company Nippon Steel can buy U.S. Steel this year, but he has not solved the problem, which is U.S. Steel has just gotten too small and not profitable enough, and shareholders have been forcing some kind of action, such as a sale or some kind of consolidation. So I'm not sure that Cleveland-Cliffs coming in with basically saying, we'll buy this at a bargain basement price. I mean, that's their first offer. I'm sure they'll probably go higher. But I'm not sure that solves the problem, because part of the problem here is these big steel mills, these big, really costly steel mills are just outdated and cost inefficient. And the new model is the smaller mills that you find in the South, including some right to work states where the workers are not unionized. That's what everybody in this industry wants. So what do you do about the big mills in the South? I mean, if Cleveland-Cliffs or any domestic company were to buy U.S. Steel, but not for enough money to continue operating those big mills, you know, you would see workers losing their jobs anyway. So we're seeing this process play out, but I think there's a lot more to come here. And I wouldn't rule out that Nippon Steel could still end up with U.S. Steel. I just don't think it's going to happen before the 2024 election, but it does seem plausible that the election is over. Nippon Steel does provide guarantees to support some of those or all of them probably that have to do union jobs, and maybe that would allow this to go through, but it's just too touchy to happen in an election season.
Well, and it's also interesting because not only are the politics domestically play a role, but you know, the politics with China, with Japan. I almost said China because I was going to say China. Obviously, there's tension there. Japan, things are good. So you know, in other words, does this create a problem where none existed?
No, the problem is we're losing union jobs. I mean, that is the problem. And I think in the heartland, it matters a lot less who the purchaser would be. What matters is these good paying blue collar jobs have been going away. There's no secret about that. And I think any politician would be crazy to dismiss the fact that Trump won in 2016 because for one reason he won anyway was he appealed to those blue collar workers in Midwestern states who feel like their way of life has been eroding and nobody has been doing anything about it. So there is no way Biden is going to give an edge to Trump on that in 2024, especially since Biden, he describes himself as the most pro-union president in American history. So this is about getting blue collar votes and persuading those people, especially in swing states, that somebody in Washington is watching out for them and does have their back. I don't think it matters where the foreign purchaser would be. It could be the UK, it could be Canada, our neighbor to the north, and I don't think it would matter.
So speaking of the election, there's some new Quinnipiac numbers out today, and in particular, they look at Michigan, which is another state that's going to be key in the race. And it looks like there that, I don't know. I'm seeing this number here that Donald Trump has more support, although I'm seeing in the text that also Biden does have some support there. So it depends on what the race looks like, I guess.
Yeah, and we're going to have tons of little data points like this during the next 7 months. Quinnipiac actually describes that as a head-to-head outcome because that 3-point margin that Donald Trump has is within their margin for error. We're going to keep talking about this. I mean, the thing to look for in Michigan, blue collar state, Biden did go there and he stood on a picket line with the United Auto Workers last year. Again, trying to show some solidarity with union workers. But there's also a heavier Arab American presence in Michigan than in most other states. And that's the state where some of those voters, they put down the famous uncommitted when they went to the Democratic primary a few weeks back, just to signal their displeasure with Biden, a little too staunchly behind Israel, they are saying, and not standing enough behind the Palestinians. So that is a factor. I mean, many things to navigate here for Biden, given wars overseas and difficulties in the U.S. economy. So I guess if I were Biden, I would interpret that poll as definitely more work to do in Michigan.
All right, well, we'll keep in touch with you as we get all those other little data points you were referring to. Thanks,
I'll be back.
Thank you.
Bye, guys.
Count on it. All right, that'll do it for today's Yahoo Finance Live. Be sure to come back tomorrow, 3 p.m. Eastern, for all of your coverage leading up to and after the closing bell. Have a good night.